All right, so today we're going to talk a little bit about stocks. We're also going to, for that, we'll review the test real quick because I did get a couple emails back, people asking me a couple questions. So I just want to reinforce that, and we'll look at some examples for stock trades and stuff as well. So first exam review, I think it was pretty straightforward. You know, we talked a lot about opportunity cost. And again, it's a huge thing in your life. You know, your time is precious. Your money is limited, all those things. And so if you're spending your money, your time on one thing, you're not doing another thing. So that's where that goes. And there's an example, you know. Going to a movie. I don't know if that's a thing anymore. Anyway, been to a theater and I was like the only person there. Kind of weird. Well, obviously I was with somebody. But anyway, retirement planning should begin as soon as possible, right? If spending exceeds, you really don't have, there's no magic solution. You can't borrow yourself out of this, and obviously you can't work yourself to death. And two jobs, you know, one good job is probably better. Two other jobs, and whatever, you do what you got to do, but you're probably going to get burned out. Long term, you need to learn to live within your means. Liquid assets, cash. Cash is liquid. Everything else is real estate, definitely not. Stock, pretty close, but in a retirement account, if it's in a retirement account and you're not age 59 and a half, you're going to be taxed at 10% penalty, and then you're going to be taxed again on that income. So anyway, student loans, long term, because all these things are greater than a year. Car loans, student loans, all those things take longer than a year. So if it was less than a year type things, be short term. Best measure of wealth is net worth. How much do you actually own, not owe. Owe would be liabilities. So you get your assets minus your liabilities. Hopefully it's a positive number. If not, I mean, if it's it depends what that debt is. You can accumulate net worth by borrowing money as long as it's in an asset that's appreciated. If it's depreciated, if it's a vehicle or something, mobile home, whatever, you're lost. Why is it important to monitor your debt level? Same thing about living within your means, being able to cover those payments. Compound interest, so money today is worth more because you're going to invest it, do something with it. Time value of money, exactly. Second one. Compounding, that's earning interest on interest. Head of household, so we're never switching to taxes. That just means you would otherwise be claiming single, but you don't want to claim single unless you're absolutely forced to, because that's the highest tax rate. So in this case, you've got somehow some sort of dependent. Has nothing to do with owning a home. No. Whoops, did I skip by one? So this one, I think I actually had a typo in here. If anybody missed that, you can go ahead and bitch at me a little bit. Jane purchased stock 7 years ago for $20,000. Okay, so this anyway. It should have been comma. In 2015, she sold the stock. Anyway, I'm confusing myself even with this. Big picture is, you know, hopefully you buy low, you sell high, you make a capital gain. Is that gain longer than a year? Yes. So it's a long-term capital gain. Purchasing which of the following? So interest on vehicles, consumer stuff, boats, all that other stuff, not tax deductible. Interest on a home mortgages, and obviously home improvements are tax deductible. So how do banks make money? They take in money and they, pay you a smaller amount, and then they lend it out at a higher amount. Your ability to cover short-term deficiencies, again, liquidity. Okay, credit card frequently. Pay off the balance every month. That makes you a convenience user. So, again, if you didn't learn this on the test, you'll learn it in life. If you carry a balance on your credit card, you're going to be paying interest on that credit card. Credit cards love that. They want you, well, whatever. They don't openly say it, I mean, but they appreciate it when you carry a balance because they make more money. Credit card companies make money two different ways. One is by charging the merchant, the vendor, whoever sells the stuff. You know, if they sell something for $3,000, they only get about whatever, 2,900. Anyway, they lose about 3% in terms of transaction charges. But if they can get the holder of the card to pay interest as well, and this is where the big money comes because their interest rates are high, that's where they make money as well. But you don't have to be part of that. You can pay off your balance every month if you can. Certainly, though, before you start doing other things with it. And this comes to not only opportunity cost, but also investing. We're going to talk more about investing tonight, but if you're carrying a credit card balance, you have no business investing because you can't invest enough to catch up with what you're paying on that interest. Credit card advances, yeah. Credit cards are not like ATM cards. If you use a credit card to advance cash and you pay off the balance completely, it doesn't matter. Cash is the exception. If you pull cash out, they start charging you interest on it from right then. Plus, you've kind of identified yourself as, you know, whatever. Maybe you're in a bad spot or whatever, but they love to dogpile. So they'll probably also charge you a service fee. I had somebody break into my, break-in, not much of a break-in, but they took some of those convenience checks out of my mailbox. And whatever. I didn't ask for these stupid checks. In fact, I've gone paperless just to prevent any of that. But anyway, they went in there. They got some of those silly convenience check things that are sometimes attached to your statement, and they wrote themselves a check for like $300. Stupid. But the way I found out about it is all of a sudden I had a $300 charge on my credit card, plus I want to say it was $10 or $20 for some convenience charge, where the credit card company was going to charge me $10 or $20 to have used their silly check. So it all got refunded, and I don't know whatever came of the person, but for $300, it's probably not worth the jail time that they expose themselves to, or at least the chance of it. Which of the following is true about bank cards? So, yeah, they can be an excellent source. They can be your friend if you use credit cards well. Yeah, they can keep you from carrying huge amounts of cash in other accounts that might be, liable to identity theft type things, but also will not be invested. If you can keep your checking and savings accounts, your day-to-day accounts down to a smaller amount, and keep your other money perhaps in a brokerage, perhaps someplace else, but invested, making you money, that's much better. Finance charges apply only to the ones, so again, convenience user. APR, annual percentage rate. You have to check these things quickly. There's always going to be errors. It's funny, the random errors seem to be in the credit card's favor, but also the theft. If you catch it quickly enough, it goes away pretty easily. Collateral is that security that lender has, and so the better the collateral, something absolutely identified, like say a vehicle, a home, a piece of property that's tied directly to the loan, you're generally going to find the interest rate on those quite low because the lender has some recourse. If it's just a credit card loan with a bunch of random garbage you bought, yeah, the interest rate's going to be higher because that lender's exposed to more risk, because trying to recoup all the stuff you bought at Target or Walmart or wherever you shop is not realistic. So again, which one has a cheaper loan? The one that's collateralized, the one that's secured. Same thing. Cosigner, don't do it. Come up with another solution. But a cosigner means that you are signing on to help somebody out who can't get the loan by themselves. Probably a reason they can't get the loan by themselves. Purchasing the home, you don't pay the commission. So kind of a no-brainer there. Homeowners Association. Some people love them, some people hate them. I whatever. I try to not find myself in a situation where I'm dependent upon, and the only way to do that is to have some acreage where you're far enough away from your neighbors where what they do is their own business. Anyway, but for most people, you will be forced into it. There will be some sort of homeowners association. And if you're buying a piece of property, you definitely need to do some research. Is it a good one, a bad one? You know, some of these homeowners associations, because maybe a developer wants to get in, doesn't want to wait for the city or, the borough, whoever, to build the roads. So they'll say, okay, we're just going to build all these roads. And then they pass them on to the homeowners association. And when you're buying this home, you don't realize that your homeowners association is responsible for all the road maintenance, all those bills. Maybe you get a lower tax rate. Maybe not. Maybe you have headaches. I don't know. You need to do some research. There's a lot of variables that homeowners associations can enter into it. Anyway, fixed rate mortgage always stays the same. Doesn't change. Same on the first day or day whatever, 30 years later. So adjustable rate mortgage, interesting. Do the research. It is a bit of a speculative type thing when you get involved in one, but it can be fortuitous. But anyway, and it may be the only way you can get it done. You may not be able to afford the mortgage at all, which makes it even scarier, but again, you have to live somewhere. Ignoring risk is not a management strategy. You need to acknowledge them, have somebody else accept them, insure against them, avoid them to the max extent possible, but ignoring them is not realistic. Comprehensive covers everything else. So this is an automobile insurance. Deductible, that's how much you pay before the insurance company starts paying. Standard homeowners, they can't cover floods. It's just not able to be done. This can be called a personal article floater, a rider, an addendum, whatever. But if you've got excess property in one certain category, you definitely want to check on that. How to reduce your premiums usually is to increase the deductible. And then health insurance is most often done through your employer, because that's typically a group policy. It's going to be a group policy, and hopefully it's subsidized by the employer. So the insurance itself is not as expensive because it's a group policy, and then if the employer's paying a portion of it, obviously it's even better. All right, so investing in stocks. Okay, so again, I'm going to kind of rag on the authors in the book and all that kind of stuff because things have changed a bit. And the newer editions are more advanced, but there's a lot of people who never invested directly in stocks. And I'm not saying you should do that. I'm not saying you should steer away from mutual funds. I do like mutual funds, and if you recall, we'll talk about mutual funds next week, but mutual funds are a broader, more diversified product. But they're typically comprised of individual stocks. So knowing what the underlying securities are makes you a better mutual fund investor. But if you choose to invest in mutual or in stocks directly, it's not as hard as it used to be. It used to be difficult. It used to require a broker. It used to require commissions. And it used to just be prohibitively hard. Now it's not. So we'll discuss some of that. Stocks, okay, we talked about stocks again, what they are, just a chunk of a company, an ownership interest, an equity position. You'll hear them referred to as equities because their equity implies ownership. Anyway, stock exchanges, these are just the guys who facilitate stuff. Do you care who they are? No, not really. New York, nah. I buy and sell a lot of stocks, and I care not a whit what exchange they're on. In fact, most of the stuff I buy and trade are done on over-the-counter OTC type exchanges that may not even have a physical building. That's not again, things are simpler now with the internet within automation and the rest of that. So old school, floor traders. This is they ring the bell and they get out there in the pit and they have this. It's too slow. It still happens, but not something you or I would see. You want these things, though. You want this fluid. You want these all types of people involved in the stock market. You want these people, these vultures, sitting on the sidelines looking for good deals. They're not necessarily vultures. They're the ones who keep the markets from dropping too far. If those people were not there, if these predatory people were not out there, the market would fall apart, basically. So, other stock exchanges. So again, I'm not going to get wrapped up in this because it's not an important characteristic. It's how it used to be. OTC, so over-the-counter, electronic communications networks. Literally, this still, though, even though it's electronic, it's physical presence because of trades and some fairly devious practices, front-running trades where they know your order is going to be placed and the brokerage with whatever nanoseconds will put an order in before and make a little bit of money. I mean, people will pay for physical presence, i.e. shorter cable runs, because even though, the speed of light, speed of electricity, all that's 186,000 whatever units they are, damn fast, a couple feet on a cable does make a difference when you're executing some of those trades. So it's interesting. But for what we're looking at, electronic communications networks, the money market makers, again, predator type people, maybe not the kind of people you want to spend time with, but they do perform a function. Less stringent listing requirement. There used to be a certain, status associated with being traded on the New York Stock Exchange, or even worse, getting delisted. But a lot of the big tech companies, the names that you're familiar with, they never started out there, and the Apples, the Amazons, the Googles, they emerged through other means over the counter, and so depends on what industry you're in. But for tech sector, certainly not critical to be on a big exchange. You can do after hours trading, not that common. The volume's a little less, and that can present some problems. When we talk about volume, we talk about the number of trades being executed. The worst thing you want is a no volume kind of trade, because you're trying to buy something and there's only a very few people in the market. Well, somebody with a very high price, if you placed a market order, it might go for a price that's considerably different than what the current market has. Anyway, getting down to the weeds, but I generally don't do after hours trading. No person needed to perform at the exchange. Yep, can be all electronic. Price quotations. I'm going to show you how this has been there's been a revolution caused by the internet. Financial newspapers, and these are all long-term. Brokers, most of them never earned their worth. I interviewed to be a stockbroker way back when, and it was funny. They didn't care a bit about any sort of finance or stock analysis. No, they wanted salespeople, and I disappointed them. I mean, because I didn't get the job because they asked what I like to do, and at the time, I was a big runner. I like to go hiking. I like to do all these individual activities. They wanted, golfers and guys who hung out in bars with their buddies and just had a big, huge, rich friend network that they were going to be able to sell all these stocks to. I'm not saying I'm a loner, but they definitely wanted a gregarious person who's going to be able to sell, not so much even provide information. So we'll look at some quotations. We'll look at how that works, and I'll show you some examples in just a second. So here's how they're saying it used to happen. And this is, I remember I was in the Middle East, and oh my God, I was struggling because I was actually trying to trade stocks, and the internet was just emerging, and it was hard to get information. And so the stuff I was getting was days late, and it was this tabular data with a, a high and a low, and it was just not easy to get anything done. So this would show you we're looking at 52 weeks, so a year span, traded at 62.10, as low as 49.40. The stock, typically this would be a ticker, so it might be ZUG or something like that. Here it's obviously a income stock because there's a dividend, a yield associated with it. Price to earnings, more in depth than we're going to go. Volume, how much has been traded. What did the stock close at today? So the net change was plus 27. So obviously the day before it was 49, whatever, 73. Anyway, you'd have to do some interpolation. Well, let me show you what we're looking at now. So if you look at charts now, I've pulled up a couple here, but this is, let's just go back to this is just Google Finance, so easy to find. But rather than that information that they were presenting before with just a snapshot, tabular data, it's just not very useful. Here we've got an interactive chart with a lot more information. And the time period, here's 1 day, stuff's been rough for the past couple days. 5 days, 1 month, 6 month, year to date, and 5 year, and then since the inception of the thing, so it came out about 2016. It's traded on the over-the-counter. Yes, this is Grayscale Bitcoin, so ticker symbol would be GBTC. So all kinds of information that wasn't available in the old newspaper thing. There's also, and this is just the Google one. Google's got more advanced stuff, but let's look at a different chart here. This is from Yahoo. So again, I'm not a subscriber to any of this stuff. I just use it. I mean, I do have a Yahoo account, but I'm not signed in or anything. And the same with Google. But this is presenting even more information. They call these things candlesticks, which, man, this seems complex. Not really. On this day, it started trading at the bottom of the candlestick and up at the top. So those are the highs and the lows. Let me see. You can tell the volume. So this is the volume on the bottom. And you can look at the actual where the chart is off to the side, the numbers. I mean, there's just so much more information. And here I haven't signed in, but they're giving me recommendations, and pretty smart recommendations actually. Nvidia is a whatever they make. They really started out with graphics cards, but those same cards were used in a lot of the Bitcoin mining type machines. Now, you don't have to be a Bitcoin fan, but if their products being adopted for super fast processors, that's what led to a lot of this growth. In fact, going back a little further, I've had Nvidia for quite some time, and so it goes through some dips. Everything was kind of affected by COVID and the rest of it. But now they had a bit of a run due to those same processors being used in AI. And so just the amount of information that is available is just amazing, especially, and we could spend a whole lecture on talking about these charts, but let's say, I said that they're a processing company. Let's compare them to AMD, another company in that same realm. And here's in the blue is AMD. So you can say, wow, NVIDIA's doing something right. They kind of mirrored the competition, but all of a sudden they're excelling when maybe AMD's faltering. Now, whatever, you need to do due diligence. You need to spend some time and figure out what the other factors are that cause this divergence. But all sorts of interesting information. And again, to buy right now, they're saying basically you'd be foolish. Now, if you're in it for the long term, even in the long term, I wouldn't be buying any new Nvidia right now, especially when they're on a downward trend. Let's look at a 1 month run. Yeah, things are going down, so they're probably likely maybe to go further down. Trying to guess the bottom, they call that trying to catch a falling knife. It's very dangerous. But anyway, bearish and bullish, old school terms. I don't think we really discussed that. Bullish means you're expecting things to go up. Bearish means you're expecting things to go down. But you don't like looking at the candles, so you want to look at lines instead. You're trying to explain to a friend and you want to start drawing on the chart, and you're going to put lines and stuff. You want to look at the different ranges. I mean, you can do whatever you want, and it's just way more powerful than this tabular data. So again, it gives you access to information, because the big boys, the big brokers back in the day, they had some guy working out charts like that, and so they had maybe more information than you had. So it really wasn't a level playing field. Now that you got access to charting and things like that, the retail investor might be able to compete a little bit. Okay, purchasing and selling stocks. Yeah, brokers. So again, they're first off, not that you're going to deal with these people, but one of their problems was they were very optimistic because they're selling stuff. The more you buy, the higher their commission. And this happened also, where must disclose, should disclose, sometimes didn't disclose. I've more than once have gotten a letter from a lawyer saying that class action lawsuit against some brokerage saying that the stock that they were representing was not legit. They had an ownership position. Don't think that that's gone away. In fact, it's gotten far worse. I could, the whole misinformation, disinformation on the internet is whatever. I personally believe it's kind of a joke. But in terms of stock trading, this is where it gets dangerous because it's called pump and dump. If you ever watch a movie, what is it, Wolf of Wall Street? It's not for everybody's taste, but the basic concept the underlying concept in that movie was pump and dump, where you get some no-name stock, and it definitely helps if it is a no-name stock because there's not as much information on it. You hype this stock. You go out on the internet. You go out on Wall Street Bets. You go out on everything else and talk about what a great stock this thing is. You get that stock, in the public eye. People start buying it. The stock price starts going up, not based upon the quality of the company, but based upon the hype. And then, if you're the person who orchestrated this at the right time, you pull the plug. You sell everything at that higher price. Finally, the price just crumbles because the underlying company was worthless, and you're done. You as the person who dumped it, you walk away with a stack of cash, and you go on to the next scam. So it can be a little bit dangerous. The SEC is involved, Securities Exchange Commission, that prevents some of this, but on the unregulated stocks and the penny stocks, it's more common than not. So anyway, we're not going to talk a lot about broker skills because for most of us, you're not going to be using a broker. Brokerage commissions, and that was the problem. We had they started coming out with discount brokerages. Now they've just said most brokerages, any brokerage I've used, I haven't paid a stock commission in years. It's a competitive market, and the big boys don't charge commissions, and so unless you're some high wealth individual who's getting expert advice, that's been worth it and making you money for most of us, no need for that. So placing an order, you need to know the name of the stock, but this whole business with the ticker symbol, you don't get too wrapped up in that. The internet can figure that out just fine. Buy or sell, you decide what you're going to do, number of shares. This is all used to be the way it was done, round lots, odd lots, higher commissions. If you didn't, now you can buy fractional shares, and I'll show you a thing on that in a second. Different orders. Okay, so I'm going to once again step back, and this time we're going to watch just a small chunk of a YouTube video, because I don't want to open up my own account here, because I'm not that confident in my ability to not reveal a bunch of public information or private information on public. So I'm going to show you just a little snippet of somebody else's video that I'm shamelessly stealing from.
For setting up your account, you will need to fund your account with cash.
So the guy's going to get some money into the account.
Your checking account and transfer cash directly from your.
So this whole, it used to be a real ordeal. Going to your brokerage, writing a check, letting it clear. Now, no. This is, this guy's account, his total account value is whatever, less than 15 grand, and he's funding the account. I'm just going to show you a little bit about how he actually trades the stock and show you how a lot of the things that the lecture references are now kind of out of date. They've been overcome by a better system.
Your checking account to your brokerage account. You can do that with the transfer button here. The next step is to select Trade in the upper left-hand corner of the home screen and choose the appropriate drop-down for the type of security you're trading. Today's demonstration will use stocks and ETFs. You can see here we have $25 available to buy stocks with in our account today. Next, you will need to determine the ticker sign of the security you plan to buy.
So this guy's not a high roller, obviously. We're just looking at kind of a joke account. He only has $25 in his account. But that's the cash that's available, the liquid part. That other, whatever, 14 grand or whatever it is all allocated already in securities. So if you want to get rid of one security and buy a new one, yeah, you would have to sell that other security, wait a few days for that to settle, and we could go there about that. I mean, the whole settling time is kind of an artificial delay. It favors the brokerages because they get to sit on your money for a few days and earn money off it. That's why virtual exchanges, you'll probably see this settling date and blockchain transfers. It's going to make all this obsolete. But right now, you have to sell one stock, wait a few days, and then buy the other stock. So anyway, he needs to put a symbol in here. He's going to indicate that he's going to buy, and then you'll see just how trivial the share amounts can be.
If you don't know your company's ticker sign, simply begin typing in the company name, and the ticker will automatically populate. You can also buy ETFs the same way. For example, if you'd like to buy the S&P 500 index, you can type in SPY here. Once you've entered the ticker of the stock or ETF you wish to buy, you will see the current share price automatically appear. In this example, you can see Amazon is currently trading at $3,389. Next, simply select the Buy button. Now, a great feature on Fidelity is that you can now buy what they refer to as stock slices. This means you can buy either a fraction of a share or a fixed dollar amount of a stock. In this example, the price of one share of Amazon stock is currently $3,389. However, I only have $25 in my account right now, so I cannot afford to purchase an entire share. I can still invest in Amazon by simply buying a fraction of a share, however. So for example, I could enter in 0.005, which would be $16.95 currently. Or I could enter in a fixed dollar amount, for example, $25. So you don't need to have thousands of dollars to get started investing. So I'll just go back and enter in 0.005 for today. Now, the most confusing part for most people is selecting the order type. Market orders will execute as quickly as possible at the best available price. For most large liquid stocks, the likelihood that the stock price changes between the time you place the order and the time the trade is executed is minimal. Market orders are by far the most common, but the other option is to place a limit order, which means you decide the price to buy the stock at.
Okay, so we'll go through market and limit orders and the rest of it. But you can see that this, if you can order something on Amazon, you can buy stocks. You can order these fractional silly amounts. Nobody cares. It's not like you're tying up somebody's time. This is all done automated training. All this math, it makes no difference to the computer. You're not wasting anybody's time. You're not costing a lot of money. Amazon is kind of a unique example because they've got this freakishly high share price. I think I actually own a share of Amazon. I don't know why I bought an even share, but I did. But anyway, this price is just it's unseemly large. If you're going to buy 10 shares or something, I mean that's like 33. It's just whatever. I think they're trying to impress people. They could change the stock price quite easily. They could do a split, was what they call it, and they could say, okay, for every 10 shares of Amazon that you previously owned, or every one share, you now own 10 shares of the new shares. So you would have a share price of $338 and whatever. You haven't created any money, but you got the stock price more manageable. But for some reason, Amazon and I think Facebook as well, they just kind of let their stock price roll. It's a psychological thing that they're whatever they just want to do. Again, Fidelity's not unique. We could go to Vanguard, we could go to Schwab, we could go to anybody else. They're all just so similar that don't feel that there's something special about Fidelity. I just use them just because I'm familiar with their process. But you don't need to have some sort of allegiance to a particular one. Now, what does make sense is if a company you're working for, they have all their retirement going through Fidelity, which is actually how I ended up when I was back working full-time for UA as a full-time professor. I did, their retirement plan was through Fidelity, and so I just migrated some of my stuff over to Fidelity. And whatever, I used to be big into Ameritrade, and they've gone away. They're now Schwab, and whatever. So not a dime's worth of difference between all the different companies. Don't feel like you are missing out necessarily. If somebody's got a good program like zero commissions, then they're all going to adopt that or they're going to go extinct.
The trade will not be executed until the stock falls to the price that you set. If the stock doesn't reach the limit price, the trade will not go through. Note the stock market is open Monday through Friday from 9:30 a.m. to 4 o'clock p.m. Eastern Time. So if you place a trade outside of those hours, then it will simply be executed on the next open market day. Once you've entered in all the details, you can hit preview to review the trade one last time, and then if it all checks out, place the trade. Now, I'm going to leave you with one last tip, which is to make sure you've set up your investments to automatically reinvest dividends.
Okay, and we'll talk more about reinvesting dividends. I don't disagree with what he's saying. It keeps your money working, and a dividend off of a $16 worth of stock is just going to create a lot of unnecessary paperwork. So, good tip there. So anyway, getting back to what we're talking about in terms of purchasing and selling stocks. So you saw the mechanics of buying it. Market order means exactly what he said. Buy it now at the next price that's available. If it's a super low volume day, perhaps the day before, maybe it's Christmas Eve, maybe it's getting around New Year's, not much volume, probably not the best time to be placing large market orders because a lot of people just aren't present. And so the normal market, you want that liquidity, that volume in the market, and it may not exist on the super low volume day. Now you can start doing these limit orders, and let's say you have a life, and you don't want to get wrapped up in some emotional stock buy and buy at the wrong price, or what stock's trading in a certain range. You can put in a limit order. And you can also do stop orders. So a stop order would be if it reaches a certain level. So I used to do this with Twitter, real Twitter, back before it was called X. I mean, but this was before Musk, and it was just kind of a company that never made much money, but they were just kind of floating around. So we're talking 3-4 years ago, and they were trading this range between $30 and $60. And so I bought and sold that company many times. And what I would do is I would buy when it hit 30, and I usually had a limit order that would execute when the stock price hit 30 or thereabouts. And then I would set in another order for to sell when it got 60. So you could do, buy and sell limit orders. Not a problem. Now, let's say something's going on and it seems like it's going to, still the same Twitter stock. And let's say it seems like it's going to be blasting. The economy's doing well and it's approaching 60 and I'm about to have my stock sold. And I'm like, I think it's got some momentum. And again, do some analysis. Don't just trade on gut emotion. But if you've got some sort of validation why you think that price is going up, what you can do is you can put in a stop order, and what you would do is maybe put in a trailing stop. So what you do is, again, it could be done through that same platform, back on Fidelity, Vanguard, whoever, and you'd put in a trailing stop and do a little research on it, but it's not hard to do. And let's say the stock's approaching $60, and I'm happy with that, but I want to go to the moon. I want to, ride this thing as far as it's going to go. But I don't want the price to start slipping back down to 30 and me just, be on this roller coaster and never capture any of this gain. So what I do is I'd put in a trailing stop. And that order would be, let's say the price is advanced above 60 and now it's at 62. Things are going well, but I don't want to sit here and waste away my every day watching this thing. So I just go ahead and put in a trailing stop, and I put it in based upon on the price that I want to sell at if that stock price descends. Or it could also be, you could have it on the other side, but for this example, descend. So I put in a trailing stop at $60, right? And so now if the stock price keeps going up, goes to 64, well, my trailing stop, or my stop order, trailing stop's slightly different, but my stop order is still down at 60, so it doesn't get executed. And now all of a sudden the stock price keeps going. It goes up to 65. Well, my sell at 60 is still not going to be executed because it needs to descend back to that level. If the stock price was to descend to 59, the minute it went through that first trade that dipped below 60, my order would be converted basically into a market order and would be executed on the next trade. So I would be stopped out of the market, hopefully as close to 60 as possible. Now, I also, in my sloppiness, I refer to a trailing stop. A trailing stop is slightly different in the fact that this is even more automated and even more hands-off. I put in a trailing stop, say, of a certain percentage or maybe even a dollar figure. I put in a trailing stop that's $2 below the prevailing price. So I execute this trailing stop, or I enter this trailing stop in the order platform, and let's say the stock's trading at 64 right now, I would have a trailing stop at 62. And as long as that stock price keeps going up, my trailing stop would just follow along behind it. So if the stock goes up to 67, my trailing stop would follow and now be at 65. And so now if that stock price bounces below 65, boom, my trailing stop becomes a market order and is executed at the next trade. Is it wise to put a trailing stop that closely behind? Probably not. There'll be some volatility through the day, and maybe a single trade or two on a low volume day or a low volume time. Somebody gets a trade snuck in there down at 63 or 65, and even though the momentum of the stock is still going up, I got taken out of the market because of that one kind of rogue trade. So maybe a $3 or $5 or 5% or something like that might be better. Usually even trailing stops, they go even a wider percentage, maybe 10, 15%, something like that. Anyway, it's getting more advanced, but all kinds of things you can do that did not used to be available to a retail investor. And so a lot of times when people say you don't want to invest in stocks, if their point is because you lack the diversification, because you have all your assets in a single stock, that's valid. But if they say it's because it's too hard to execute, that's not true any longer. You can do all kinds of stuff. So, stop order, we talked about that. Yeah, no commission. If you're paying commission, you're messing up. You should not be paying commissions. Stock on margin. Oof. All the technology here is not your friend. The ability to buy stocks, Bitcoin, stuff like that with borrowed money exists, but don't do it for the most part. You're no longer investing, you're speculating. And part of it has to do with the limits, because you have to have a certain amount of margin. You can't be, if you want to buy 100 shares of some company, you need to have the cash to have purchased at least 50% of them. Well, the problem with a margin account is that your underlying asset, your cash equivalents in this account is the stock itself. So let's say you bought whatever number of shares of Tesla, and so you have this huge margin debt that's denominated in cash. You owe that money, but your margin account is funded with Tesla stock, meaning that if Tesla stock goes down, you need to put in more cash. You need to buy more Tesla stock to fix this margin situation. You need to buy more to get up to that 50%. And when you can no longer do that, you get what they call a margin call, where you get a notification that basically, hey, you're out of compliance with the Federal Reserve. You either put up the cash or we're going to sell the stock at its current price. So you get tapped out at the bottom. And so, anyway, it gets more involved. I kind of gave you the involvement, but my explanation of it may have confused a few of you. But buying on margin can be dangerous because your collateral in this case is the underlying asset, which is dropping in value, and therefore your loan is to be paid back in cash from that security. So it creates a problem. Short selling stocks. Okay, again, we're getting into speculative stuff, but if you see this on a mutual fund, and you may, there's going to be a thing when you're trading mutual funds. It's called the prospectus, and it tells what the portfolio manager can do, what the fund manager can do, and they may reference short selling. And short selling means selling a stock that you don't actually own. So what you want to do in this case is a company's, it's easy to forecast a company going down. It's really hard to pick winners, but certain times it's, you can just look at a company and go, yeah, this company is hopeless. The economy's against them, their product's no good, their outlook is not good, they're overvalued, whatever. For some reason you think that stock price is going to bad things are going to happen. And so what you want to do in this case is to sell short. And you're going to get whatever X numbers of shares today and sell them, but you're not going to pay for them till a date in the future because you don't own these shares. You're short on these, and you're anticipating that when you actually have to pay for these shares, that the stock price is going to have dropped and you will have made money. So you sold them at the higher price, and when you actually go to come forward with the cash for those stocks, the price is going to be lower, and you'll buy them for that lower price. And anyway, tough gig. This is one of the things about investing in stocks is it's not a zero-sum game. If a company does well, everybody can make money at the same time. Anybody who's invested in that company can make money at the same time because that company's gotten bigger, gotten more profitable, gotten whatever, and the share price has gone up. And so you can maybe credibly trust the advice of others because they're not against you. When you're short selling, there's somebody on the other side of that bet. Somebody maybe smarter than you, or probably somebody who's doing it full time, who thinks exactly the opposite of you. So for some reason, you have to question yourself. You got to go, what does this person see that I'm not seeing? Because when you're short selling, it's not a zero-sum game. Or it is a zero-sum game. If you make money, that other person lost the money. And so I short sold Tesla once or twice and made a little bit of money, but I never felt very confident in it because it just kind of tumbles your mind, and you're also betting against somebody who whatever, for some reason you have to feel that you're smarter than they are, and I don't know. So analyzing stocks. So when we looked at that one Yahoo Finance thing, I mean, they actually had bearish and bullish. They had some reason why they thought the stock was going to go up. And anyway, they did some sort of analysis. That analysis, I believe, was probably based upon more fundamental analysis. Stock prices don't necessarily... well, they don't represent the value of the company today. They're future looking. What you're buying is the future potential of that company, where they are going. And so there's different ways to judge that. Technical analysis, man, you can spend all day on YouTube or whatever platform and look at guys doing technical analysis, and they'll look for formations on those charts and kind of divorce themselves from other economic factors. What interest rates are and the rest of that. No, they're mainly chart guys, and they're looking at patterns on the chart, and they're looking for support levels and breakouts and all this. It's a language all to its own. I don't find it's that powerful. I mean, people make money at it. They somehow figure it out. But I'm much more comfortable in fundamental analysis. Fundamental analysis is where you take in, kind of the real world, and you look around and you see what's the company's product like, what's the, economic conditions. Most of the stocks I've bought, number one, I don't buy them just upon, that seems like a good company, because there's a lot more to it than that. You generally need to look for a couple, 3 recommendations. I mean, Warren Buffett, the Berkshire Hathaway guy, and a few other folks have always been more on the fundamental side, and they want things they can kind of reach out and touch. They would not have invested in Twitter, but because they didn't, that's why I was kind of drawn to Twitter, because other people were kind of scared of it, and so they didn't have the same level of investors in it. But anyway, fundamental analysis, a classic, at least one that I did fairly well on was Lululemon. You know, I was teaching full time at the university, saw the products, quality products, saw the, you know, the very little marketing on their part, but the bags and everything else, and kind of the adoption by students that it was, you know, a pretty good company. And then at the time I was paying for a subscription stock advisory service. They came through and were very bullish on it. And then a few other sources. And so, you know, invested in them and did all right. So that's more fundamental analysis where you know maybe a little something about the product or the sector or have some reason. And then you can do some research. Technical analysis, I'm just not that comfortable analyzing charts, and I'm just not able to set aside all this other information that's available. So if I was to do any sort of technical analysis, it would be in combination with fundamental analysis. Firm's financial condition, all this stuff is comparative. You know, income statements, again, that's the power of you know, the internet and being able to compare one company to another, because they need to be in the same field. They need to be, you know, so many of the companies, you know, the Amazons of the world, that didn't seem to be profitable at all and now are incredibly profitable. You know, people would have missed out on a whole lot of growth if they would have done a conventional analysis. Again, you need to be more forward-looking, and sometimes those things don't show up. Now, if you're looking in the same, you know, within the same sector, yeah, one company that's got a huge financial problems versus the other, those are more easier to identify. So I'm not saying these aren't important, but some of the best companies early on would probably not have passed some of these tests. So, yep. Anyway, it's all supply and demand. Different factors will cause it, and sometimes it can be hype. It can be just sediment. Right now, I mean, we've been through a strange year. The stocks were actually doing quite well, and nobody could quite figure out why. And now, all of a sudden, this past week or two, they're not. And so, who knows? Fraud, yeah, there's always going to be things going on. Enron, other Bernie Madoff. I mean, there's you need to do your due diligence. You need to figure it out. And it's gotten more and more challenging. And then you add into that crypto-related things, and it's daunting. GDP, we're not doing macroeconomics here, but you know, gross domestic product, fiscal policy, which brought down a lot of the market as interest rates went up. There's so much linkage now where it's tough for one economy to be doing well when the other ones are lagging. So you see a lot more interdependence than you used to. You can't necessarily escape an economic downturn, because it's usually across all the nations. Stocks perform better when interest rates are low. So that's one of the primary reasons why the market was not doing as well and may not do so well, because interest rates are high. Tech stocks were very sensitive to interest rates. Federal Reserve, they try in monetary policy. If you saw the amount of money that's being printed in our national debt, at some point there's reasons for pessimism. Inflation, yes. Keep in mind that the people calculating the inflation, you know, are not necessarily the ones you want to be doing that calculation, because they're going to try to make things seem a little bit better than perhaps they are. Industry conditions, certainly. And then, so again, there's all sorts of information out there. First off, you need to find some sort of trusted information. Clickbait on the internet is not a valuable source of information. Lots of things go into a company's stock price. So there's always going to be variables, COVID, wars, things like that. So when we talked about stocks, we talked about an ownership position. Okay, you actually own a chunk of the company. Here, a company is going to acquire capital, or a municipality or whatever, some sort of government agency. They couldn't sell stock, so they're going to borrow money. And you, as the investor, could loan them that money. So a long-term debt security. Par value, so say it's a $20,000 bond. They issue a $20,000 bond. You buy it for $20,000, and at the end of the maturity date, you get that 20 grand back. 10 to 20 years, but there's all sorts of different bond maturities, especially short-term bonds. They give you payments, and then they give you your money back. No big deal. Bad thing for you is a call feature. This is, say, because interest rates are really high right now, bond market's in trouble, they have to issue bonds that pay a super high interest rate. Say they issue it, say, paying 8%, something like that. They may, if economic conditions improve, they may want to get rid of that 8% bond. So they put a call feature in on it, which means if interest rates drop down to where they can sell 5% bonds, they give you notice that they're going to call your 8% bond, and basically you get your money back, and they cancel the contract, and you're done. So not a good feature for you as the bond investor, because it doesn't benefit you. It just it allows the bond issuer to cancel out an unprofitable bond. Convertible bond, yeah. I don't typically invest in bonds. I have, but not very often. But anyway, this could be changed into a stock. So it should go from a loan to a stock on corporate bonds. For that flexibility, yeah, a little less in terms of return. So, how bonds work. If the stock price, let's say you had that bond that didn't have a call feature, it's paying 8%, and it's a $20,000 bond, it would be worth more than $20,000 if the rates dropped to 5%, because you could get 8% if you own that bond. So people would be interested in buying that bond from you, and so you could sell it for more than its par value. Conversely, if you had a 5% bond and current bonds are going for 8%, well, nobody wants your stinky bond, so they're not going to pay you as much for it. So it can work both ways. They do sell in the secondary market, so although you might get the bond from the original company, the original municipality, you can sell it in a market as well. So same brokerage firms, the Fidelity, the whoever, the TD Ameritrade or Schwab, I guess now would do that. Treasury bonds, so those are bonds issued by the federal government. But they're super secure, so the interest rate's going to be super, super low. Municipal bonds, so state and local, low risk, sometimes lower. Depends on your tax bracket, but anyway. Low default risk, interest is taxable. So that's a federal bond from that's not, it's issued by the federal government itself, so it's not going to be excluded from federal taxes. It's the state and local ones that are different entities than the feds. Making the decision what's going to be better for you, well, I'll talk about that in a second. I think I'll have an example. Corporate bonds, a little bit riskier, just because, corporations can go bankrupt, whereas, federal governments just borrow more money. State governments, they just raise taxes. There's lots of ways that those guys can recover, and even though they're financially, insolvent, they can continue on. Corporations can't do that, so they can default on you. Junk bonds are a special class. Not all corporate bonds are junk bonds, but ones that are companies that aren't paying the money back that are going into default are junk bonds. And so what you need to know, again, you go to those same charting type things and get a whole lot more information. It's not going to be as exciting. There's less moving parts, but just the same, you can find the prices on those. And so, as I mentioned, interest rates definitely affect the value of your bond. Tax implications again. So again, you look at, it's a stream of payments that are coming into you, the dividends. And yeah. Default risk is the risk that they may not pay back. And again, a third party can evaluate that risk. Moody's, Standard & Poor's, Fitch is also in there. So you'll see the rating of a nation, perhaps change if they're really in debt. You see the solvency of a nation be degraded because they're taking on too much debt. So not all risk is bad. I mean, if you want a high yield, you need some higher risk. But if it's into junk status, obviously your risk is off the chart. It's only a lot of interest if it's actually paid to you. If the company goes out of business, then that's not a good investment.
So, BB doesn't sound bad, but yeah, actually it's down in the junk range. So, AAA, all caps, or AAA over here. Anyway, unless it's an A or better, you're getting down into junk status. These ones are already in default. They're not even being paid. We talked about calling a bond, and we talked about the interest rate problems. People will tie these to, their kids' education perhaps, or funding for a project where they're going to get that lump sum of money back. People will diversify. They'll buy a series of bonds with different maturity dates. They'll create some sort of retirement plan based upon bonds. All sorts of options that can be done. Setting up the maturities, because it's a known, basically a contract, when you're going to get your money back, what the dividend's going to be. They're quite predictable as compared to stocks. Term project, we talked about that last week. Again, be working on that. So I was just going to say one thing on the tax-free bonds. Let's see where they've got that. The way you decide, some people say, "Oh, I really want a tax-free municipal because it's a no-brainer. I don't pay any tax on it." Well, that's going to be factored into the dividend that's paid. So let's say, you've got two different bonds out there, and let's say the tax-free bond is paying 6%, and the fully taxable bond's paying 10%. How do you make that comparison? Well, that's where you need more information. You need to know what your anticipated, marginal tax rate's going to be. If you think you're going to be, say, at a rate that's going to be charged, you're going to be at a 30% tax bracket for that bond income, that final tranche of income that's coming in up there at the top, you know that if you're getting 10% interest and it's taxable, well, obviously you're not going to be able to keep all of that. 30% of it, since you're in a 30% tax bracket, is going to be taxable. So your effective tax rate is, your effective yield after considering the tax rate is 7%, right? Because 30% of that 10% is gone to taxes. So the yield on that fully taxable bond is 7%. And you said you could get the other one tax-free, but it's only paying 6%. So in that case, and assuming that the risk is equal between the two, you'd go, well, I think I want even though the one is taxable, at the 10% rate, I'm still getting effectively 7% remaining after taxes, which is better than 6%. So that's how you make that calculation. Now, if you're somebody who's not making a whole lot of money or has some sort of tax situation where you're not in a 30% bracket, say you're down in a 20 or something like that, then it would change those numbers. Or let's say you're living in California and your effective tax rate is 63%, well, you get a tax or a yield of 10%, you're only keeping what, 3.7% of that. Yeah, so anyway, you have to know what your marginal tax rate is to make that decision. So that'll be the final explanation. All right, but some of the stock stuff may be kind of above your heads. I don't know. To get involved with even a small amount of money, it can be kind of fun. It's kind of interesting. You might have an easier time funding your investments if it's something that's kind of more interesting. But in any case, just to understand how stocks work, what the different strategies are, you'll be able to make a more informed decision in terms of mutual funds and other areas where you are more likely to invest. Even though you're probably not going to be executing short selling strategies, it does behoove you to understand that they exist and why they exist. Anyway, good luck on that. Talk to you next week.